Have you ever wondered why billionaires always seem to be flying on private jets, driving luxury cars, and living in massive mansions, but their actual salary is like $1 a year? Mark Zuckerberg's salary? $1. Elon Musk? $1. Larry Page and Sergey Brin at Google? You guessed it, $1 each. But somehow, they're living better than people making millions of dollars in regular income. Here's what nobody tells you about wealth. The truly rich don't pay for their lifestyle the way you and I do. They've figured out a completely different game, a game where their company pays for almost everything, and they end up keeping way more money than someone earning 10 times their official salary. Here at Simple Money, we've spent months breaking down tax filings, corporate structures, and financial disclosures. And what we found is honestly shocking. Not illegal, not even unethical in most cases, just a completely different operating system for life that most people don't even know exists. Today, I'm going to show you exactly how this system works, and more importantly, why understanding it might completely change how you think about building wealth. Here's what's really happening in America right now. There are two different tax systems. Not officially, but in practice, there absolutely are. In one system, you work hard, you earn a salary, and before you even see that money, the government takes their cut. Then you pay for your car, your house, your food, your phone bill, all with what's left over. After tax dollars, in the other system, your company pays for your car, your housing, your meals, your travel, your phone, sometimes even your personal security and your kids' education. And all of that happens before taxes even enter the picture. Same lifestyle, completely different tax treatment. Think about it this way. Imagine two people, both living the exact same life, same car, same house, same meals at nice restaurants, same travel schedule. Person one is a high-earning employee making $300,000 a year. They pay about $90,000 in federal and state taxes. Then they spend their remaining $210,000 on their lifestyle. Person two owns a business that generates $300,000 in profit. But they structure things so the company pays for their car, their home office, their business meals, their travel for business development. Their actual salary might be just $70,000. They pay maybe $15,000 in taxes on that. The company handles the rest through business expenses. Same lifestyle. Person one paid $90,000 in taxes. Person two paid $15,000. That's a $75,000 difference every single year. And here's the uncomfortable truth that nobody wants to say out loud. This isn't some fringe tax scheme. This is standard operating procedure for anyone who understands how the wealthy actually operate. The system isn't designed for people who trade their time for money. It's designed for people who own the entity that generates the money. So let me show you exactly how this works, starting with what I call the company wallet. Here's the basic principle. When you own and operate a company, there's a massive gray area between personal and business expenses, and the IRS actually gives you a lot of room to operate in that gray area, as long as you follow the rules. The key word here is ordinary and necessary. If an expense is ordinary and necessary for your business, the company can pay for it. And here's where it gets interesting. The definition of ordinary and necessary is way broader than most people think. Let's start with transportation. If you're an employee driving to work, that's a personal expense. You pay for your car, your gas, your insurance with after-tax money. The IRS is very clear about this. Commuting is personal. But if you own the company, suddenly the math changes completely. Your company can lease a vehicle. That lease payment is a business expense. The gas, business expense. Insurance, business expense. Maintenance, business expense. Now, technically, you're supposed to track personal versus business use, but here's the thing. If you're the CEO of your own company, almost everything you do has some business component. Driving to meet a potential client, business. Attending a networking event? Business. Taking a prospect out to discuss a deal? Business. Driving to a conference? Business. The car is available for business use 24/7, so the company pays for it, all of it, before taxes. Meanwhile, your employee counterpart earning the same total compensation, they're paying for their car with money that's already been taxed at 30 to 40%, and we're just getting started. The second major category is what I call the dining advantage. Business meals are 50% deductible. That's the rule. If you're having a meal where business is discussed, your company can pay for it and deduct half the cost. Now, if you're a regular employee, you might get to expense some client dinners, but you're still eating regular meals on your own dime. Breakfast, lunch, dinner, that's coming out of your after-tax salary. But when you own the company, the lines get much blurrier. That breakfast meeting where you discuss strategy with your business partner, business meal, lunch with a potential vendor, business meal, dinner with an advisor or mentor, business meal, coffee with someone in your industry, business meal. I'm not saying every single meal becomes a business expense. That would be ridiculous and probably illegal, but a significant portion of your meals can legitimately involve business discussion. And here's what makes this particularly powerful. It's not just about the meals themselves, it's about the lifestyle it enables. Think about a high-earning professional couple, both working corporate jobs, making $400,000 combined. They're probably paying about $120,000 in taxes. Then they're spending their after-tax dollars on groceries, restaurants, everything. Now compare that to a couple running their own business generating the same $400,000. They're having breakfast meetings, lunch meetings, dinner meetings. A huge portion of their food consumption happens in a business context. The company pays, they deduct 50%, same lifestyle, completely different tax treatment. And this is just meals. We haven't even gotten to travel yet, which brings me to the mobility matrix. This is where things get really interesting. Travel is a massive expense for most people. Vacations, flights, hotels. If you're a high earner, you might spend $20,000 to $30,000 a year on travel, all after-tax dollars. But business travel, that's different. That's fully deductible. And here's where successful business owners get creative. Not illegal creative, just strategic. You need to attend a conference in Miami? That's business travel. Flight, hotel, meals, all covered, but the conference is only 3 days. So you extend the trip to a week, bring your family. The business expenses are fully deductible, the personal days are on you, but you've already got the flight covered and the hotel for the business portion. Or consider this. You're expanding your business and need to explore a new market. You need to see the area, meet potential partners, understand the local business environment. That trip to Barcelona to explore European expansion, business travel. Again, I'm not suggesting you fabricate business reasons for personal trips. That's fraud. But when you legitimately operate a business with growth potential, there are real business reasons to travel to interesting places. Compare this to an employee. They want to go to Barcelona. That's a vacation, paid for with after-tax dollars. Probably cost them $10,000 out of pocket, which means they needed to earn about $15,000 before taxes to afford it. The business owner exploring Barcelona for legitimate expansion, the company pays maybe $12,000, fully deductible. Their out-of-pocket cost is essentially zero for the business portion. Same trip. $15,000 difference in real cost. This is the power of structuring your life through a business entity. Now let's talk about the asset advantage. This is where things really start to compound. Here's something most people don't understand about assets. When a company buys an asset, that's often an immediate expense or a depreciation deduction. When you, as an individual, buy an asset, that's just spending money. Let's say you need a laptop, As an employee, you buy a $2,000 MacBook Pro with your after-tax money. That $2,000 cost you maybe $3,000 in pre-tax earnings. A business owner, the company buys the laptop. $2,000 business expense. Immediate deduction. The real cost to them is about 60% of that after-tax benefits. Maybe $1,200 in real economic cost. But it goes way beyond laptops. Your home office? If you run a legitimate business from home, you can deduct a portion of your rent or mortgage, utilities, internet, everything. The IRS has specific rules about this. The space has to be used regularly and exclusively for business, but if you meet those requirements, a portion of your housing cost becomes deductible. I've seen business owners legitimately deduct 20 to 30% of their housing costs this way. On a $3,000 a month housing situation, that's $7,200 a year in deductions, which saves them maybe $2,000 to $3,000 in actual taxes. Meanwhile, the employee in the identical housing situation, they're paying with fully taxed income. And we haven't even talked about the really big assets yet. Real estate held by the company, vehicles beyond just a car, equipment, technology, furniture. When you operate through a business entity, so many things that feel like personal expenses can legitimately have a business component. The key is documentation and legitimacy, but when done correctly, the tax savings are enormous. The fifth element is what I call the compensation control. This might be the most powerful aspect of all. When you own the company, you decide how you get paid, and that decision has massive tax implications. Let's break this down. There are basically three ways to get money out of a company you own: salary, distributions, or dividends, and retained earnings that increase the value of your ownership. Each one is taxed completely differently. Salary gets hit with income tax and payroll taxes. That's your 15.3% for Social Security and Medicare, plus your income tax bracket. If you're in the 37% federal bracket, that's over 50% total. Distributions and dividends, those are taxed as capital gains in many structures. That's 20% federal for high earners, plus your state rate, maybe 25 to 30% total. Retained earnings that grow the company value, not taxed at all until you eventually sell, and even then, capital gains rates. So wealthy business owners do something really smart. They pay themselves a reasonable salary, enough to cover basic living expenses and keep the IRS happy, but not massive. Then they have the company pay for as many lifestyle expenses as legitimately possible: the car, the meals, the travel, the home office, the phone, the laptop, the subscriptions that have a business purpose. What's left over? If they need it for personal expenses, they take distributions taxed at capital gains rates. If they don't need it, they leave it in the company to grow in value. Compare this to a high-earning employee. Everything they earn gets hit with the highest tax rates first. Then they spend what's left on their lifestyle. The business owner structures their life, so the company handles much of their lifestyle expenses before taxes even enter the picture. Then they carefully manage how remaining profits are extracted to minimize tax impact. It's not about evading taxes. It's about legally structuring your financial life to operate within the most favorable parts of the tax code. And here's what most people don't realize. The tax code is actually designed to encourage this. The government wants people to start businesses, take risks, create jobs, so they built in these incentives. Now here's where things get really interesting, and this is the part that might make some people uncomfortable. The system I just described, it's completely accessible to way more people than you'd think. You don't need to be a billionaire to benefit from this. You don't even need to be a millionaire. You just need to legitimately operate a business. That's the unlock. That's the secret. The tax code doesn't care if your business makes $50,000 or $50 million. The rules are basically the same. A freelance consultant making 80,000 a year can structure their life through an LLC or S corp and use the exact same strategies I just described. Company car, business meals, home office deduction, business travel, asset purchases. The specific dollar amounts are different, but the tax treatment is the same. So why don't more people do this? Three reasons. First, most people don't know this is possible. They think business ownership is for other people, not them. They've been conditioned to think of themselves as employees. The idea of structuring their life through a business entity never even occurs to them. Second, it requires actual business activity. You can't just create a sham corporation to run personal expenses through. The IRS will destroy you. But if you're legitimately providing services or products, even part-time, these strategies become available to you. Third, it requires more complexity, more accounting, more documentation, more planning. For someone earning $40,000 a year with simple finances, it's probably not worth it. The tax savings wouldn't justify the hassle. But for someone earning $80,000 or more, especially if they have any entrepreneurial inclinations, the math starts to make sense really quickly. And here's the uncomfortable truth that nobody wants to admit. The tax system is fundamentally designed to favor business owners over employees. That's not a conspiracy theory. That's just how the code is written. Employees are easy to tax, predictable. The money comes out before they ever see it. Business owners are harder to tax, more complex, more variables. So the government incentivizes business creation through tax benefits. This creates two completely different economic realities. Living the same lifestyle in the employee world versus the business owner world can literally cost you 30 to 50% more as an employee. That's not an exaggeration. That's just math. Let me tell you about Marcus. Marcus is a senior software engineer at a tech company in Austin. He's good at what he does, really good. He makes $250,000 a year. By most standards, he's crushing it. Marcus drives a nice Tesla Model S, leased about $1,200 a month. He lives in a great apartment downtown, $3,000 a month. He eats out a lot because he works long hours, probably $1,500 a month on restaurants and food delivery. He travels several times a year, takes his girlfriend to Mexico, hits up a music festival, visits family, probably $20,000 a year on travel. Marcus is living a legitimately great life, but here's what Marcus doesn't see. His $250,000 salary, he takes home about $160,000 after federal, state, and payroll taxes. That's $90,000 gone before he makes a single purchasing decision. Then he pays for his Tesla with after-tax dollars, $14,400 a year. His apartment, $36,000 a year in after-tax dollars. His food and dining, $18,000 a year. His travel, $20,000. Do the math. That's $88,400 in major expenses alone. He's got about $70,000 left for everything else. Savings, retirement, emergency fund, entertainment, everything. Marcus is doing fine, but he's on the hamster wheel, working incredibly hard, making great money, but never quite getting ahead the way he imagined. And here's the thing Marcus doesn't realize. His lifestyle costs him way more than it needs to, purely because of how he's structured his financial life. Now, let me tell you about Priya. Priya is also a software engineer, similar skill level to Marcus, but Priya made a different choice 3 years ago. She started taking on consulting clients, built up a small roster of companies that needed her expertise. Eventually, she left her job and went full-time with her consulting practice. Now she operates through an S corporation. Priya's business generates about $250,000 a year in revenue, same as Marcus's salary. But Priya's life looks completely different from a tax perspective. She pays herself a salary of $100,000. That covers her basic living expenses and keeps the IRS happy with a reasonable W-2. She pays about $25,000 in taxes on that. The remaining $150,000, That's business profit. But before it becomes profit, the business has expenses. Her Tesla? That's a company car used for client meetings and business development. 14,400 a year, business expense. She converted one bedroom of her apartment into a dedicated office. That's about 20% of her space. 20% of her 36,000 in rent, 7,200 is now a business deduction. Business meals? She meets with clients, potential clients, and fellow consultants regularly. About half her dining, 9,000 a year, has a legitimate business component. Half of that, 4,500, is deductible. She attended 2 conferences this year for professional development and client networking, 8,000 in travel, business expense, added up, that's about 34,000 in legitimate business expenses that directly support her lifestyle. After all business expenses, Priya's company has about 66,000 in profit that gets taxed at capital gains rates as an S-corp distribution, about 13,000 in taxes. Total tax bill for Priya, about 38,000. Compared to Marcus's 90,000, same 250,000 in income, Priya pays $52,000 less in taxes. But here's what's really wild. Priya and Marcus have almost identical lifestyles. Same car, similar apartment, similar dining habits, similar travel. Marcus is paying for all of it with after-tax dollars. Priya's business is handling much of it before taxes enter the picture. Over 10 years, that $52,000 annual difference becomes $520,000. Over 20 years, $1,040,000. Same skills, same income, same lifestyle. $1 million difference purely because of structure. Here's what most people don't realize about wealth building, and this might completely change how you think about your career and finances. It's not actually about earning more money. I mean, yes, earning more helps, but that's not the fundamental difference between people who build real wealth and people who stay on the hamster wheel. The fundamental difference is whether you're operating inside the employee tax system or the business owner tax system. Everything I just described, that's not about being rich. That's not about having special connections or insider knowledge. That's just about understanding which side of the tax code you're operating on. The tax code is basically a set of incentives. The government wants to encourage certain behaviors, starting businesses, creating jobs, taking economic risks, investing in growth. So they created tax benefits for people who do those things, not as a loophole, as an intentional feature of the system. When you operate as an employee, you're in the simple path, clear, predictable, but expensive, because employees don't create jobs or take business risks. They're just trading time for money. When you operate as a business owner, you're in the complex path. More paperwork, more rules, more responsibility, but much more tax efficient because business owners create economic activity. The people who build serious wealth understand this distinction. It's not that they're smarter with money, it's that they're operating in a different system entirely. And here's the thing that might blow your mind. You don't need permission to switch systems. You don't need to be selected. You don't need special credentials. You just need to legitimately operate a business, provide value to clients or customers, and structure your financial life accordingly. That could be consulting, freelancing, coaching, creating digital products, e-commerce, service businesses. The specific vehicle doesn't matter nearly as much as the fundamental structure, because once you're operating through a business entity, you have access to the same tax code that billionaires use, the same rules, the same benefits, just different dollar amounts. This is why you see so many wealthy people with multiple businesses. It's not just about diversification, it's about maintaining access to the business owner tax system, staying on the favorable side of the code. The question isn't whether you can afford to start a business. The question is whether you can afford not to. Because every year you spend operating purely as an employee is a year you're voluntarily paying 30 to 50% more for the same lifestyle you could have as a business owner. That's not an exaggeration. That's just the mathematical reality of two different tax systems operating side by side. So let's recap what we've covered today. The company wallet. When you own a business, transportation costs can become business expenses rather than personal spending. The dining advantage. A significant portion of your meals can legitimately involve business discussion, making them partially deductible. The mobility matrix. Business travel opens up completely different possibilities than personal travel, with dramatically different tax treatment. The asset advantage. Everything from laptops to office space can become business expenses rather than personal purchases. And the compensation control. When you own the company, you decide how you're paid, and that decision has massive tax implications. These aren't character flaws or moral failings, these aren't even secrets. They're just different operating systems, different sides of the same tax code. The ultra wealthy understand this instinctively. They structure their entire lives through business entities, not to evade taxes, but to operate within the most favorable parts of a system that was designed to reward business ownership. And here's the empowering part. You have access to the same system. Today, right now. You don't need to wait for permission or achieve some arbitrary level of wealth first. You just need to start thinking like a business owner instead of an employee, even if you currently have a job, even if you're just starting out. Because the question isn't whether the business owner tax system is better than the employee tax system. The math on that is crystal clear. The question is whether you're willing to embrace the complexity and responsibility of business ownership to access it. That's a personal decision only you can make, but at least now you understand what you're choosing between. The two systems exist. They're both legal, they're both available, and they produce completely different financial outcomes over time. Which system do you want to be operating in 10 years from now?